Professor Barada here. I want to go over budgeting with you quickly and go through a problem and show you how to basically solve the concept of the production budget and the purchasing budget for materials. So production budget is a production plan for resources needed to meet current sales demand. Basically, the way to approach this is to think about your finished goods inventory T account. Basically, your finished goods inventory T account begins with your beginning inventory, the budgeted sales from your sales forecast, from a cost of goods sold number, or the number of units that represent the sales on this side of your T account. You have your units and ending inventory. Many of the problems will tell you that a company requires 2 months of inventory or likes to have 3 months of sales inventory on hand at the end of a period. So the units and ending inventory plus budgeted sales less your beginning inventory is going to be your required production. Your required production is essentially the plug you need to balance your T account. The required production on the debit side of finished goods is the credit from WIP. If you recall in earlier chapters, a credit on WIP is a debit to finished goods. The credit on WIP represents the cost of goods manufactured. And that's what basically this represents, the cost of goods manufactured. From there, we can also build our purchasing budget through the T account, because our purchasing budget is going to need this number right here to balance that T account. So let's go through a quick problem. We have a mountain bike company that expects to sell 25,000 bikes next year. Management estimates that the beginning in inventory will be 2,000 units, 3,500 units respectively. Prepare a budget production for next year. So let's create a T account for our finished goods. So we have a finished goods inventory. We're going to create basically a production budget. Beginning inventory. Ending inventory. We have our sales units, and then what's coming in as a debit is going to be units required for production. So in our problem, we are told that we expect to sell 25,000 bikes next year. So that number is going to be on the right side of our T account. This management estimates that the beginning and ending inventory will be 2,000 units and 3,500 units. That means the units required for production is simply the balancing that we need to balance our T account. So ending inventory plus sales units is going to be 25,000 plus 3,500 minus 2,000, and that means we need 26,500 units to produce for that year. And essentially, you don't really need this schedule. You can use the T account. Now, from here, you can manipulate your data. Many problems might give you this number, the beginning inventory, and the sales unit, and ask you what the ending inventory is. Or they'll give you the required units for production and ask you how many units in sales are needed for your budget. So you're just basically using your T account to solve for any missing information. What you need to know is the basic inventory formula in a T account. Beginning inventory plus some kind of addition, whether it's production or cost of goods manufactured, less ending inventory equals cost of goods sold. The materials inventory is the same thing except slightly different definitions. We have a beginning inventory, we have an ending inventory. The required usage converted from the production number, this number here, comes from this number on your production budget. You may have to do some problems where you need to do the finished goods budget first to get this number so that you can put that on the credit side of the material inventory. Required usage is a credit because it's what's the number of units needed that go into production and eventually become a finished goods. The plug here are the purchases. Now be careful when you do a materials inventory because purchases or any of these numbers might be in units, and the problem will ask you for dollars. You're going to have to know what the standard cost or the unit cost is, multiply that by your units to get your dollar amount. So in this problem, our bike requires two parts, a frame and tire. Let's look at tires for a moment. For every bike we made, we need two tires. The cost is $30. Beginning inventory is 2,000. Ending inventory is 3,200. Units to be produced next year from the production budget is 26,500. So what is our purchasing for the year? Rather than do this problem, we can use a T account. So let's do a materials purchase budget. And we have beginning inventory. We have our purchases as a debit. We have our ending inventory. And we have our units required for production. We know that number is 26.5, but these are in units. The problem then tells us that units to be produced next year is 26.5. So we know we need 2 tires. The ending inventory is 3,200 and beginning is 2,000. So let's just plug that in. This is just for tires. So the difference to make this balance is take 3,200 plus 26.5 minus 2,000, and that's going to be 27,700 units. But here's the thing. The units is in basically represents a bike, not tires. Our material purchase budget is in tires. We need 2 tires for every bike. So technically, our units required for production is not 26,500 bikes, but 26,500 times 2, because we need two tires for every bike. So this number is actually 53,000. The beginning and ending inventory in the problem are in tires. So we don't have to adjust for that. So 3,200 plus 53,000 minus 2,000 means we need 54,000. We have to purchase 54,200 tires. But that's in units. The problem tells us that the cost of the tires are $30. So in dollar terms, this 54,000 has to be multiplied by $30. And there's our answer. The cost of the materials will be $1,626,000. Let's look at a problem for homework. It's a materials purchase inventory problem. And we have a company that buys tiles and prints different designs. It buys the tiles from a small company, so at all times it keeps on hand an equal to the tiles needed for 3 months' sales. The tiles cost $1 each and must be paid for in cash. The company has 20,000 tiles in stock. Sales estimates, and these are in tiles, based on contracts received, are as follows for the next 6 months. Estimate purchases in units and cash required to make purchases in January, February, March. So the company has a beginning tile inventory of 28,000. So I'm just going to change this to be our materials. inventory, our beginning is 28,000 tiles. The problem says that the company likes to keep 3 months of tiles on hand at the end of the period. So in January, they want to have 3 months of estimated sales, which are these three numbers: 18.8 plus 13.7 plus 13.4, which equals 45.9, which they have right here. So that's going to be our ending materials inventory, 45.9. Let's make this purchases, and the credit side is going to be, remember, we're dealing with purchases, not finished goods. The credit side is going to be units required for production. They give us that number in the problem, which is 12,800 in January. So our purchases are merely the plug. You take 45,900 plus 12,800 minus 28,000, and we're going to need 30,700 tiles. However, those are in units. The amount we have to purchase in dollars, the problem tells us they're worth $1 each. So conveniently, $1 times 30,700, the cash needed will be $1 $1 times the number of tiles that we have to purchase. And there's the 30,700. Now we move on to February. Your ending inventory now becomes your beginning inventory. So your beginning inventory is 45,900, which is taking from the last month's, January's, ending inventory. Now your ending inventory in February is going to be the next 3 months. So it's going to be March, April, and May. So 13,700 plus 13,400 plus 10,200 is 37,300. Units required for production are February's units right here, 18,800. So the purchases needed for February are going to be 10,200. We know it's $1 each. Therefore, in February, we have to purchase, per our budget, 10,200, which is given to us here. Moving along to the next month, March, and I'm just going to make this March now. Beginning inventory is going to be your ending inventory. Ending inventory is going to be 3 months from March. So it's going to be April, May, and June. So April 13.4 plus May 10,200 plus June, 7,500, gives us 31,100. $31,100 is the ending inventory in March. In March, we're budgeting in March 13,700 units required for production. Therefore, ending inventory of 31,100 plus units required for production minus beginning inventory gives us 7,500 in purchases, which is the cash we need at $1. And so you'll see now how we got to 3 months. So that's the approach you need to take to do one of the homework problems in this week's Connect for the purchase budget and production budget as well. It's the same concept. So look over your lecture notes. They give you some T accounts that you can follow. And thank you for listening.